Easter and happy Passover to everyone. Interesting season of holidays this year, obviously. A lot of virtual family dinners. We are going to repeat the webinar we did this Tuesday on April 7th, and very much at the beginning, I'd like to sincerely express our apology. The webinar obviously is, the point of the webinar is to review the points that we presented in our white paper, the framework for a strategic response to the coronavirus. And we've never exceeded the limit of our platform, the GoToMeeting platform we have, until Tuesday. So unfortunately, some folks who had signed up couldn't get in, so we're very sorry. It's never happened. We didn't anticipate it, but we tried to rectify it as best we could, and that's the purpose of today, is to do it all again. And hopefully everyone who didn't get in Tuesday can be with us today. If you have any questions whatsoever, please throw them into the chat window, and Terry will stop me. I really would rather take questions during the webinar than wait until the end. It's always better to try and have some kind of a dialogue, even though this is a point to multi-point discussion. But I'll thank everyone for doing that. So, yeah, we wrote the white paper. We started club benchmarking on April 1st, 2009, which was in the middle of the financial meltdown in the last recession, and so we got to see from the front line. And another perspective of the front line is I was on the board of my own club during that period of time. I served 10 consecutive years on my club's board. The last 3 I was president. So I got to see one club, and then since then I've dealt with over 500 clubs one-on-one, meaning I've done presentations there, and got to kind of see the fabric of what happened and how that last recession impacted the club industry, and it did. And really the purpose of the white paper is to try and learn from the past, and to try and make sure we do things maybe a little bit more strategic than we did last time. We're obviously in a situation that none of us has experienced before. I still shake my head and think about it and say it's amazing that air travel, I saw last night on the news, air travel in March was down 96% year over year. 96%. That's just unheard of. And that's not the only industry that's down 96%. So obviously the situation is something from an economic, and never mind the real issue, which is the health and life issue, but the economic aspect of it is really something. But it's also just as apparent when we look at it that we know it will not last forever. We don't know how long it will last yet, but it won't last forever, and there's a good chance that a year from now we'll all be the way we were 3 months ago. So in the end, from my standpoint, 2 important points. The virus crisis is an issue, but it's not the issue. If we're talking in terms of clubs success, club finances, the virus issue is a tactical issue. It's not a strategic issue. I'm not trying to minimize it, but it's not something that we have to, change everything over. I did a little research in preparation for the webinar. This wasn't in the white paper, but this is a list of the recessions since 1980. I just picked 1980. I got out of college in 1980. It's a long period of time, 40 years. And I just had my own thought was as a setup for the webinar. I was trying to think, how often is the U.S. in recession? So a 40-year period is a pretty good broad view. The United States has been in an economic downturn 56 months since January of 1980. There have been 483 months through the end of March since January of 1980. That means the economy was in recession for 12% of the time. And if you look at the GDP decline in the far right column, you can see that the last recession, which has been labeled a Great Recession, which was relatively long and relatively sharp in terms of its decline. We've got past it. We just had coming into this recession, or if this is a recession, which it's likely to be, but we don't know yet. I'll get to that in a minute. But the period of economic expansion, I did a little more research this morning because I wasn't quite sure on Tuesday. Thought I knew. The economic expansion coming into this recession was the longest economic expansion in the history of the country. And the way a recession is defined is by an organization in Cambridge, Massachusetts, not far from where I sit right now, called the National Bureau of Economic Research. That's the organization that actually gets to tag officially if an economy was in decline and for how long and when it started and when it stopped and what the peak and what the trough were. And the basic definition of a recession is 2 consecutive quarters of economic decline. So the anticipation is that there'll be an economic decline in Q1 and Q2 and potentially Q3. We don't know how much, though. We've been following as a company about 12 banks, investment banks, and economic forecasting firms. If you look at their prognostications and you look at the projections for Q2 and Q3 GDP, they are all over the map. One of the prognostications in Q2 is a 28 or 30% GDP decline. And one of the prognostications is, I think, an 8% decline. There's massive variation. But when you look to the year, because they all project a rebound in Q4, and when you look to the year and what happened in the overall 2020 versus 2019, the interesting thing is all the forecasts converge, and they land somewhere between a flat economy to down 2%. So everyone expects this to be a V in a very abrupt and relatively short economic downturn. Just putting that on the table, just backdrop and context, I'd like to ask a question because most of the folks on the webinar, I'm guessing, are in clubs that are more than 40 years old. I'm sure some are on here that are less than 40 years old, but most are more than 40 years old. And the fundamental question, when you look back on this and try to relate what we've learned in the past to what we should know today, what has had more of an which had more of an impact on your club's current financial position? The 12% of the time the country was in recession since 1980, or the decisions made in 483 board meetings since 1980? Obviously, I'm asking the question rhetorically, but I think we would have 100% agreement that the answer is the second point. It's the decisions we make in the board meeting, either during or after these economic perturbations, that have the main factor. And then all of the decisions we make during the economic upturn, when the economy's growing. So with that as context, what we'd like to present in our framework is a few key concepts. The first one is this. It's really, really critical that, first off, let me back up. One of the things I always thought when I was on my own club's board and on all the board meetings I've participated in since, doing presentations or observing, well, I've been in the industry, is that there's very little context typically in board meetings. We don't often talk about the outside world. In my view, we tend to be claustrophobic. We don't think about the cause and effect. We don't think about how other clubs are doing. We're focused on our club. One club might be doing poorly, and a club 6 miles away could be doing great. We have to have context in any decision-making, certainly in business decision-making. A critical piece of context in terms of this coronavirus crisis is what the state of the club was entering the crisis. We've gathered data for 10 years. We get data from about 1,000 clubs every year. We've analyzed the heck out of it. We've learned a lot. And the purpose of today's webinar is to apply that learning to this crisis. And we have made some observations and learned some patterns, and here's one of them. If you look at the industry entering this crisis, it kind of naturally, organically sorts into three buckets. A quarter of the industry is literally shrinking. We gather net worth data from 600 clubs since 2006 for every single year from 2006 through 2019. That's a fair amount of data, a lot of work to do that. And what we've observed in looking at that data, net worth in a context of a private club balance sheet is members' equity. 25% of the industry have members' equity less today in 2020 or at the end of 2019 than they did in 2006. The reason we picked 2006 is we wanted to get the data from before the last recession to try and quantify the effect of that recession. So a quarter of the industry is shrinking. If you said that the net worth of any business, family, or organization has to grow at least the rate of inflation, which is roughly 2% compounded annual growth rate since 2006, half of the industry is worth less in inflation-adjusted dollars today than it was in 2006. That's not a healthy sign for our industry. So a quarter are literally shrinking in absolute dollars. Half are going sideways to having some moderate growth. And a quarter of the industry is growing with what we refer to as purpose. It's purposeful growth, which is a key theme of the webinar today. The reasons that we observe in the data would support, which we'll get into, in the clubs that are shrinking, their fundamental problem is they have less members today than they did in 2006. As a matter of fact, they have too few members as a result of a weak member experience to actually properly fund the club. The reason they have too few members is they have a narrow breadth of lackluster services and amenities. It manifests financially over time as a weak balance sheet, as I said, with declining members' equity and net worth, with significant deferred capital investment, and with a lack of adequate cash reserves. In my experience, these clubs tend to be oriented towards operational governance as opposed to strategic governance, and they are the clubs, which we'll see with data, that have the lowest initiation fees, the lowest dues. In some ways, the battle cry in these clubs is to keep the dues low, which is built upon a faulty thesis, the thesis being the lower the dues or the initiation fee, the more members we'll have or more will join. It doesn't work that way. I'm going to demonstrate that with data during this webinar. But generally what happens then is we begin to think like customers rather than owners. We begin to think, don't raise my dues, as opposed to what do we need to do to fund the club properly. On the other end of the spectrum, clubs that grow purposefully, about a quarter of the industry has a full membership roster. That's a data-driven answer. We've been gathering data now from about 160 clubs for a year, and we zero in on how many members there are very precisely, and whether or not there's a waiting list, and how many, and whether or not there's a sell list. But going into that exercise, I might have said less than 10% of the clubs in North America have a wait list. We're very confident the data shows that at least 20% and probably 25% have a waiting list. So those clubs have a full membership roster. They have compelling member experiences manifested by compelling services and amenity and very broad, a broad array of services and amenities. They have strong balance sheets. They're in the upper quartile in terms of compounded annual growth rate of net worth, which is 5% or more. Their assets are fresh and up to date, and they have adequate cash reserves. In those clubs, the governance model, while maybe not totally strategic, is absolutely centered on making the club better. They do and can be swinging into operational governance at times like this. Maybe that's not completely problematic, but we have to be careful with that. And the members in these clubs tend to think like owners and they take pride in the club, and they do want to make the club better, and they're willing to invest what is necessary to do so. And then you get the middle bucket, which is about half the industry, which is on one end of the spectrum on the border of the 25% that are shrinking, and on the other end of the spectrum is on the border of the 25% growing purposefully. So this group of clubs has somewhere between sideways or inflation-adjusted shrinking growth in members' equity up to moderate growth. Just to give you the data, the 25th percentile of net worth over time is a minus 1% compounded annual growth rate, and the 75th, as I said earlier, is a 5% or more growth rate. So these clubs in this yellow bucket in the middle have a compounded annual growth rate of members' equity between -1 and +5. They have average balance sheets. They're somewhere between lackluster and above average services and amenities, depending on what part of the spectrum you're in there. They have some deferred capital investment, but it's not as significant as the red bucket clubs. They bounce between operational and strategic governance, and they have a mix of members who think like owners and customers. So that's the framework or some backdrop for the discussion we'll have in terms of our framework for addressing the virus crisis. The first point we believe is this, and we've seen this, and it absolutely happened after the last recession. I experienced it in a number of ways since we started the company right then. We can't make decisions that have long-term consequences with short-term information, meaning, for example, while we're all in lockdown right now until the end of April or the middle of May or wherever it lands in the end, we shouldn't be cutting the initiation fee at the club expecting that we're going to need more members when we come out of the lockdown and we're going to get a jump on the competition. That makes no sense. We should resist hacking away at 2020 operating and capital budgets expecting doomsday. I don't even really like the idea, frankly, of running the scenarios. If we want to, we can, but I think the time could be better placed. If we need to run the doomsday scenario, we'll know at the end of April or the beginning of May we need to, and we have plenty of time to do it. It's not hard to run that scenario. We just want to stay away from using the crisis or allowing the crisis to become a cause of really slipping into operational governance. It's just not proper, and we don't know enough right now. The stock market has vacillated wildly. I read an article early this morning, a very good article, all data that indicated from this prognosticator's perspective based on 38 bull and bear markets that have occurred since the Great Depression, that it's unlikely that the stock market has hit bottom as a result of this yet, and that it's more likely that it'll hit bottom not now, but between sometime, we're at the front end of this in terms of the stock market, but sometime between now and August 7th. So the point is, we don't have all the information yet. So let's just view the crisis as it is, a tactical issue. Let's do what we got to do in the crisis, in the shutdown, but not make long-term decisions. But anytime we're making a decision, whether it's now or later in the year, we should view every decision, we believe, within the context of the bucket our club was in entering the crisis and why it's in that bucket. Because if we're going to move from red to yellow or yellow to green, or we want to avoid going the other way, we have to make sure that we don't keep repeating the mistakes that we've made to get ourselves in the place that we're in the first place. Obviously, clubs with strong balance sheets are better able to absorb the impact than clubs with weak balance sheets. And we think, as a framework, that we suggest clubs break this situation for the year into 3 time periods. Until the club opens back up, which is the end of April to mid-May, based on what we're all hearing every night on TV news, then the May-June time frame, and then July through the end of the year. So we're going to go through each of those time frames. The first time through the end of April, the club is essentially closed. I know there are some clubs, obviously there's many clubs that are producing takeout food for their members. They're doing a lot of virtual activity over the internet in terms of communication, which is tremendous. I've seen some incredible innovation from the clubs that we work with and the managers I talk to every day. Some incredible innovation, which I think will persist and help the industry subsequent. It's the necessity is the mother of invention phrase. But most of the clubs are essentially closed. The non-dues revenue is close to zero. That's the main issue during the shutdown. Members aren't in the club. Members aren't, unless we work hard, they won't be engaged. The key decision in this period of time is what to do with the staff. This has really vacillated. I started writing this white paper on March 17th, St. Patrick's Day, and things have changed. It's amazing. It's been almost a month, but what the rough framework looks like is, although it's changed a bit, I think I'll get to why in a minute. We think a third of the clubs will probably pay the staff during the shutdown. A third will pay the staff for a predetermined period of time, and a third may lay off or furlough the staff. The shift, if any, has occurred, and I think it has subsequent, is towards the layoff of the furlough, and that's got everything to do with the CARES Act, because I think we're all cognizant of the fact that the CARES Act had a very significant unemployment benefit in it, so that whatever the earnings were that a person had rights to in their given state, the federal government is adding $600 a week to that amount of money. And it might actually be better financially to actually take advantage of that than to keep the staff on the club payroll. We're going to look at the impact of the shutdown on the average club right here. We always look through the lenses of two market segments in the industry: clubs with golf, clubs without golf. About 80% of the industry is clubs with golf, 20% clubs without. Clubs without are obviously the yacht clubs, athletic clubs, city athletic clubs, dining clubs, tennis clubs. Just to get to the bottom line, because if you have the white paper, and hopefully you do, you can see all the details in that. Our estimate, and I validated this with probably 50 different clubs by now, whenever I talk to a GM or a club CFO, controller, et cetera, we have a discussion around this. I try to ask them, what did you estimate the cost of the shutdown to be to the club? And I had done this prior, but it's come out to be pretty valid. It tends to be, if it's a 4-week shutdown, it's going to be very marginal first. It'll be somewhere between 3.5% and 4.5% or 5% of the dues revenue, the annual dues revenue. If it's an 8-week shutdown, it ends up being that. It'd just be double that, somewhere between 7 and 9 or 10%. And that's it. It's marginal. It's not a fundamental impact. Most clubs, even clubs that have moderate balance sheets, can absorb the impact financially. And, the fundamental question is, does the club just absorb it via capital, cash consumption, or let's say reducing using some of the capital money this year to fund this? They'll just basically reduce the capital available at the end of the year. Or does the club maybe have a small assessment for the members? I don't know. Clubs will decide that in the end. Our recommendation is, if you can, just absorb it. It's not going to, turn anything upside down in most clubs. Some clubs, it will have an impact, and those are the clubs with the very weak balance sheets. But there is variation there. The fact is that when you look at the operating ledger or the operating model for clubs, there is variation in the industry. The way we've looked at that for about 9 years now, I actually remember when I discovered this metric, the dues to operating revenue ratio. I was writing a finance and operations report at the time for the Club Management Association of America, and came upon something studying the data that was profound, which is clubs that had a higher percentage of their operating revenue coming from dues tended to be healthier financially than clubs that had a lower percentage of their operating revenue coming from dues. And in some ways, that goes back to the mentality of the member. The clubs that have a higher ratio tend to have the members who think more like owners. And the purpose of that is this. They're not trying to fund the operation of the club through outside activity like banquets or golf outings. The club on that end of the spectrum, and this in the market segment of golf would be clubs that have a dues to operating revenue ratio, operating dues to operating revenue ratio of 55% or over, which is the upper quartile. In clubs without golf, that's 50% and over. Clubs without golf have a lower operating dues to operating revenue ratio. In the lower quartile, it's when it's below 45% or 40% respectively. So we've come up with words right now during this crisis, writing the white paper that help describe this better. One is what we call a leveraged operating model. That means we're relying more on non-member dues revenue to run the club. And the other one is dues-centric operating model. And then we have the 50% of the industry that falls in the middle there between the 25th and 75th percentile. And in the clubs with golf, that's a ratio between 45 and 55%. In clubs without golf, it's a ratio between 40 and 50%. The clubs that have a leveraged operating model are definitely going to have more of an impact. And the clubs that have a more dues-centric operating model will have less of an impact because clubs members will continue to pay dues through the crisis. And the reason we do that is because we know it keeps the club healthy. Even though we can't use the club, we're thinking like owners. We're going to fund it. If we didn't fund it, it would have a profound impact. And I was speaking with the club manager in Wisconsin. I actually did a virtual presentation to his board on Wednesday night. And he had the best analogy, just such a simple, insightful analogy. He said, "Hey, Ray, it's kind of like if you have a big blizzard in April. You can't use the club, but you're still going to pay dues." And I said, "Spot on, perfect analogy." So we have to resist any grumbling within the membership. I'm speaking now to club staff, leadership, and board. In the way I'm framing this, we have to resist that grumbling when members who are thinking like customers are saying, "Why should I pay dues when I can't use the club?" It's the same answer. You can't use the club if the rain's pouring down. Should we take a day's worth of dues off? Okay, doesn't make sense. So there's some other tactical issues that exist during this first month or 2-month period through the end of April. And I just addressed one. Some clubs, city athletic clubs, they may have a base dues that are supplemented by athletic dues where the proportion of members who pay that supplemental dues are a lower proportion of membership, maybe 10 or 20%. Those clubs, and I've talked to a couple, they may relax those dues when those members specifically can't use the club as a deference to them, but everyone continues to pay the base dues. And then, potentially relaxing or suspending the F&B minimum because we can't eat and drink. That might make sense. It's going to have a very marginal, minimal impact. I'd say it makes perfect sense. The impact, the median for the annual unspent minimum in a club is about $25,000. So, it's not going to cause any financial impact really other than on the margin. So that first chunk of time until we open back up, pay the staff or figure out how to pay the staff. Don't make long decisions that have long-term consequences, please. Let's wait till we have more clarity. Let's wait till we have more information as to what the long-term effects of the virus are going to be, and then we'll make those longer-term decisions. Let's just bound the problem to absorbing the impact of the shutdown. And if we have the time and we're having virtual board meetings, it's a great time to start digging into why we entered the crisis the way we did, even in strong clubs. Reinforce and cement what got us to be strong. And I've seen, by the way, responses to our white paper from strong clubs where the treasurers or staff or some board members are using the white paper to validate the decisions they've been making. It reaffirms. But the clubs that are in the red and yellow buckets, let's try to think if we can. Let's take a pause while nothing's happening, while we're not playing golf or eating and drinking. Let's use the time to see if we can think strategically, turning the crisis into an opportunity, and see if we can address or consider why we're in the situation we're in. Moving on to the next period that we suggest we look at, it's the May through June period. Now, one caveat to this is, if you look at Florida and Arizona, they're two seasonal areas, clearly, or many seasonal clubs. They're having the crisis kind of at their high season. It's a little bit different from them. We can't address in a white paper, unless it's 300 pages, or in a 60 to 90 minute webinar, every particular circumstance. So we're leaning towards, all this data is kind of looking at a blended view of the country. Maybe it's biased towards the northern 2/3 of the country where it is more seasonal. And the fact of the matter is, in March and April, it isn't really the peak season. But May and June are peak months, clearly. And not only that, they tend to be the months where prospective members are knocking on the door, or they had knocked on the door last fall, or they were beginning to consider joining a club when the crisis occurred. It definitely tends to be the period of time when people are joining clubs so that they can use the club to their enjoyment for the season. So what should we do in that period, and what should we monitor? First view would be, it's so funny, I keep watching these numbers that I created now 3 weeks ago. I had in my own head two scenarios. One, I think it's got a lot to do with the stock market, because in the end, the clubs cater to people who are in that group, and they kind of look at their 401k, and that's kind of what gives them the confidence or the hesitation in terms of spending discretionary income. If the Dow's at 24,000 or above, and the social distancing isn't serious after we come out of the acute crisis, things are kind of going back to normal. They're probably not going to be perfectly normal. You're probably not going to see the air travel pick up on May 31st, and there'll be people walking around with masks. And one of the club industry luminaries that we're friends with, was speaking to him the other day. He had a great thought. I thought, we may end up adopting customs like the Japanese have. Maybe we start to bow instead of shake hands. Things like that could come out of this crisis. But those aren't the things that are going to change the outcome for clubs or businesses. So if we're back to a rough normal in the May-June timeframe, and the Dow's rebounded, let's say, to the 24,000 level or above, I think things kind of look okay. That's a quick emergence. The other possibility is the stock market hasn't come back, although it's almost a 24 right now. There's still a lot of social distancing at play. People aren't going out as before. I did a webinar for NCA yesterday with Frank Vane, who's fabulous and knows so much. And he did say that, this is an opportunity for clubs from his and McMahon's perspective, where clubs can actually be a safe haven. It's more likely clubs could spread tables out, could do things in terms of cleanliness, could do things in terms of staff that would make members more comfortable going to the club than maybe going to the local restaurant. So it might really be an opportunity if that's the situation. We'll know what scenario we're in. It's not hard to figure out. We just got to watch TV and look at the Wall Street Journal. So, the two things that we have to keep in view, we believe, in this time frame, the main issue is the strength of the membership engine, which I'm going to get into in some detail. And that relates to making sure that we're measuring member recruitment and attrition precisely in relation to our own club's historical trends in that time period in 2019, 18, 17, 16, and in relation to the current market today. What's going on at the clubs around us, what's going on in our region, what's going on in the industry at large. When we look at the membership engine, there's some metrics that we put in for a reference point for the two market segments, clubs with golf and without golf. You can see that the member counts have been very consistent. This is for year-end data gathering. We've already gathered a whole bunch of data for 2019. You can see the member counts are pretty consistent year to year. If we see this stable approach. What we need to really think about is where our own membership engine is. And it goes right back to the 3 buckets. Strong, we have a full roster, we have a wait list, we have an upper quartile initiation fee. That's a strong membership engine. A weak membership engine, our initiation fees in the lower quartile of the industry. We do not have enough members to fund operations and capital needs appropriately. We have a weak balance sheet, or we have that moderate strength membership engine. We have somewhere between adequate, a barely adequate to nearly adequate number of members to properly fund operations and capital. That's half the market. So it's very easy. We can help any club that wishes us to. I'm going to get into a minute, we've begun offering a free service to the industry that will allow you to instantly diagnose your membership engine using data, not opinion. But we just want to know which bucket are we in. Just to take a quick look at the 2 segments and look into the bucket a little bit, peer into it with data. This is for clubs with golf, and it shows the distribution of initiation fees. Again, this is for 2019, very recent data. Look what the member counts do as the initiation fee increases. It's funny, after the last recession in 2009, half the market, or half the industry, to our estimate, either lowered or cut or eliminated the initiation fee. There's a thesis behind doing that. The thesis is if we have a lower initiation fee, we'll have more members. The data does not support that hypothesis. It's the opposite. The clubs with the lowest initiation fees, as you see here, have the fewest members, and the clubs with the highest initiation fees have the most members. There's some other things that come into play. It's not just the price, and this is going to be a theme of today's webinar. Clubs compete on value. They don't compete on price. Not every industry competes on price. Rolex sells wristwatches. So does Timex, if they still make them. Timex does compete on price. Rolex does not. Rolex doesn't even really sell a wristwatch. As they say in all the great PGA Tour commercials, they sell tradition and history. But the clubs are that way. We're much more like Rolex than Timex. If you look at the F&B subsidies, you see how they increase as the initiation fee increases. If you look at the allocation of money to non-golf sports, which is a data-driven view of the breadth of services and amenities the club has, you see it increasing wildly as the initiation fee increases. That's why those clubs have higher initiation fees, because they have a broader appeal to more prospective members, because they offer more to prospective members. The clubs on the left side here tend to be the golf-centric or golf-only clubs around the North America. Look at members' equity, which we talked as net worth. It climbs exponentially as the initiation fee increases, because those clubs have an adequate number of members and they're charging them an adequate amount of capital, not just the initiation fee, but recurring capital dues as well. I'll leave the net to gross PP&E ratio for now for the sake of time. Here's the same data for clubs without golf. The segment of the market for clubs without golf tend to have lower initiation fees, as you see here across the board. But you see the same pattern. The clubs with the higher initiation fees have more members. They have higher F&B subsidies because F&B is an amenity. It is not a profit center. They allocate more money to a broader array of services and amenities, and they also have a profound increase in members' equity. And they also have fresher and up-to-date assets, as evidenced by the net to gross PP&E ratio, but we'll get into that in a little bit. I'm going to take a breath for a minute. I've been talking for about 30 minutes. I am going to reach out to Terry, see if we have any questions at this juncture. Anything I could address before we move on?
Okay, Ray. One question. I hear the recommendation not to cut initiation, but what about offering deferred payment of initiation over several years?
Absolutely. We get in I forgot to address something. I can't believe it. I'll get to it later. But we actually, back to the monthly data gathering we do now for the industry for free. We have 160 clubs we've been working with for a year. We gather very precise data every month in terms of initiation fees, cost of belonging, members in, members out. We're literally a barometer for the market, the club industry market. And one of the questions we ask is, do you finance the initiation fee? 54% of clubs finance the do you allow the initiation fee to be financed over time? 54% of clubs answer yes to that question. And those that do allow for it to be paid over time, the average duration is 3.3 years. So we can actually give you more data than that. That's what I can do off the top of my head. To whoever asked the question, all they have to do is participate in the strategic monthly dashboard, and we'll be able to, they'll be able to see that data every month. So the answer is, we are advocates of that. We're not advocates of cutting the initiation fee or eliminating it, but we think that it's a very rational thing to allow people to pay it over time. Some clubs charge interest on it, some clubs don't. Some clubs make those members who have done so sign a promissory note, some don't. So there's different ways of attacking it, but we do think it's a good practice, especially as we're trying to entice those younger families. The average age, it's so funny, our data, and again, Frank McMahon's data, that when I did the NCAA webinar yesterday, exact same data, that the average age for joining a club is 42. So that's the younger family. It's a very appropriate vehicle for helping those members fund their way into the club. Anything else, Terry?
Yes. The same person, and it's actually a subscribing club, asked whether average club member recruitment and attrition data is available so that they can compare theirs to the club average.
I love that question to whoever asked it. Thank you for asking it. It's a softball coming right down the middle of the plate. If you participate in the strategic monthly dashboard, I'm going to lobby everyone to do so in this webinar. You will have that information at your fingertips every month.
Okay, and then one more question. Should a club that's in the red bucket consider raising dues right now to try to build some capital and cash flow?
So to be very direct, the answer is absolutely. One of the reasons that clubs are likely in the red bucket is it could be longer, but some of the seeds of it for many clubs, and I've worked with a lot of these clubs, so this is a data-driven answer. Some of those seeds were sown by decisions made subsequent to the 2009 recession. And what tended to happen is, in those clubs, when there was attrition early on because of the recession, and I'm going to get into this in a minute, but if you think about a simple equation, if you consider that clubs have basically fixed costs, and they do, we've proven this with data, they are high fixed cost businesses. So the operating and capital costs of a club are directly related to the footprint, the size and scale, and the amount of services and amenities delivered. There's no way to shortchange funding the footprint properly. But when a club loses some members, it has a choice. It could charge the existing, the members who stay and remain, enough to make up for the members that were lost, which means they're still generating the dues revenue necessary to properly fund the footprint. They could charge the members who remain the same amount. On the margin, they'll be slightly below what they need to properly fund the footprint. Or they could reduce dues, which many clubs did after the last recession, thinking it will entice members to join, but it won't, because clubs don't compete on price, they compete on value. And what that happens is it causes a snowball, because now you're really eating into the dues revenue to properly fund the footprint, both from an operational standpoint, which is the member experience, and from a capital standpoint to reinvest. That's what's happened. That's why those clubs are in the red bucket. So I have a slide at the end of this webinar, and the slide indicates, and we believe the data shows clearly to answer that question. Yes, we have to lean on our current owners to cough up what's necessary to get the club back on track so that we're starting to exit into the yellow bucket category, which is nothing more than having enough money to invest more in the member experience and invest more in the capital asset base.
Okay, just an observation, which is one could conclude that simply doubling the initiation fee will increase the number of members, but that doesn't seem intuitive. Member experience, amenities, and facilities all have to go into it.
Right on, 100%. And I'm not trying, I hope I didn't imply that. If I did, I made a mistake. I'm saying that the initiation fee is a result of the member experience and services and amenities. And you can't simply double the initiation fee and expect to have a member experience that correlates with that new initiation fee. But what we are saying is cutting the initiation fee will not solve a member experience, a services and amenity problem, and it will not result in more members who come in and think like owners. In fact, it's a perfect lead into this slide, because what the other factor is in terms of the initiation fee, and these are things we have to consider in May and June, before we react to what might be on the margin a slightly weaker market for prospective members, or a slight increase in attrition as a result of the economic impact of the virus. We have to make sure we're making the right decisions at this time. And half the industry made the wrong decisions the last time. That's the whole point. Our data didn't exist the last time. It does now. We can use this data to make better decisions. So to the question, I'm not saying double your initiation fee overnight and then all of a sudden you're going to have more members. But I am trying to say, don't cut it in half and expect more members, but don't expect cutting it in half is going to solve the fundamental issue if you're having membership attrition or recruitment problems, because the fundamental issue there is an inadequate, lackluster member experience, whether it's because of a depleted asset base or a lackluster member experience on the operating ledger, or both.
Okay, let's do one.
Okay, do one more.
Okay.
Yeah, sure.
I agree that discounting or slashing fees or initiation fees is a mistake for clubs. Do you see a benefit to offering a slight dues credit, 10%, to members for 1 month of the closure to create loyalty amongst members and reduce attrition, not because they need it more, as we're all in it together?
I would respectfully not favor doing that. If we're all in it together, which I think we are, we're all in it together as owners of the club. That means we're all in it together to fund the club properly. And I think the best response is really the analogy I gave earlier. Would we give a 10% dues credit if we had a hurricane or a blizzard that meant we couldn't use the golf course or couldn't get to the club for a couple of weeks or a month? It might be a little less time, but it's a perfect analogy. I don't think we would. So I think we just bear through it, and the way we get through it together is by funding the club through it together. Okay, so I'm going to carry on. We keep going. I'll take another juncture in a few minutes. So in terms of this initiation fee and the member experience and the way they relate again, some more data and some more insight. What this chart shows is for clubs with golf, it shows the membership churn. So I might have overlaid a little too thick dark line there, but the 25th percentile says 3%, the median says 5%, and the 75th percentile says 9%. We've been collecting data. This will be our 10th or 11th year that we just collected in 19. I can't keep it in my head. This data has been very consistent. It's actually changed a little bit on the lower scale. Coming out of that recession, that was 4 or 5%. The median was 5 or 6, and the 75th percentile was 10 or 11. It's come down a little bit 10 years later. It's now, and for the last 3 or 4 years, it's been very consistent, 3, 5, 9 respectively. And what you look at when you're talking favor of churn is we look at the 4 quartiles. So the upper quartile, the clubs that have churn of 9% or higher, the median initiation fee is 10 grand. Let's just walk through the quartiles to the left. The third quartile, where the churn's between 5 and 9%, the median initiation fee is 25. Between 3 and 5%, the median initiation fee is 40, and under 3, it's 50. And the point is this, and this goes right back to the questions and the dialogue. When we cut the initiation fee, we're doing it thinking we'll attract more members. On the margin, in a certain month, maybe we will, but they're not going to stick around. And when we bring those folks in, are they more likely to think like customers or owners? Obviously, customers. And this is the same data for clubs without golf. You see, it follows the same exact pattern with almost the same exact data. The churn, lower churn, higher initiation fees, higher churn, lower initiation fees. Just to drive a point home, first off, the point is as churn decreases, initiation fee increases, or vice versa. But to drive a point home, there's a profound difference between, let's say, a 4% churn and a 9% or 10% churn. I'm going to use round numbers. A 4% churn means we're replacing our membership every 25 years. A 10% churn means we have to replace our entire membership every 10 years. That is almost insurmountable.
Ray, they're asking for a definition of churn, please.
Yeah, okay, fair enough. I should have said that. I'm sorry. So churn the churn we measure is a bit specific. What it is we ask how many of your full members either left the club or dropped down in membership categories in a given year, and then how many full members did you have at the end of the year? And the churn calculation is the number that exited or dropped down in category divided by the total number of full members at the end of the year. So a club that had, let's say, 300 full members and 5% churn would have had 15 full members exit the club or drop into a lower category. So the point is this: the initiation fee ultimately, in my mind, is a test of whether a person's coming into a club where people are a community committed to a mission or not, or they're coming in as a customer to try things out. Dropping the initiation fee will not solve a member experience or value proposition problem. It only exacerbates it, because you have to have more members to have the same amount of capital. The clubs that have this member experience issue are the ones that tend to have the lower initiation fees. So when they cut the initiation fee, they're just expediting ultimately the inadequacy of capital. So again, pounding this point home, this is a club, it happens to be the Country Club of Virginia. I like to put this slide up and ask, is this a club that's healthy or not? Most clubs would kill for one of those restored style pools. They got 3 of them on top of each other. It's an amazing place. But I use it for another point as well. When you look at that footprint, and there's a whole bunch more that you can't see, but when you look at the footprint, the point is this: it's the footprint, the scale of the footprint and the quality of the footprint that drive the costs in a club. It's not whether we're being efficient or inefficient. We've done significant analysis using regression analysis and everything, and we've concluded, this isn't the point of this webinar, we have a whole white paper on this and other data, but I'll just make the point. Our analysis indicates that on the margin, maybe 7% of the overall operating costs in a club could be attributed to some sort of measure of efficiency. 7%. 93% are effectively fixed. So the point is, and this is what happened after the last recession, because of the member decline or the cost decline, trying to cut costs out of the problem, which doesn't work. The footprint costs are what they are. They're related to the footprint. They're fixed. We can't cut corners and not fund them. We can do it for 1 year. We can do it for 2, but we can't do it for 10. Eventually, it's going to rear its ugly head as a lackluster member experience, as depleted assets. We all know what it looks like when you see a club in that situation, we've probably experienced it. So the basic equation is figure out what the right costs are, fund the right costs, take the number of members we have and divide the costs, and that gives you how much any member is going to pay. Anything short of that is going to cause a problem over the long term. The key is for clubs that are trying to, I don't want to use the word turnaround, it's a little too strong, but for clubs that are trying to evolve, that might be in the red bucket and they're trying to emerge to the yellow, or they're trying to go from the yellow to the green, the data shows to our mind clearly the trick is getting everyone aligned around funding the club to stop moving in the right direction. And when we stop moving in the right direction, and we have more to invest in the member experience and the assets, that's when we'll begin to garner new members. And those new members can help then defray the cost for the overall membership, because every new member you bring in helps to mitigate the dues for everyone else until we have the adequate number of members that we need to properly fund the footprint. That is the pure and simple, the key to success in the club. We look at it as an engine. It's very simple. It's a 2-cylinder engine. Both cylinders need to work in harmony to maximize the output or efficiency. One cylinder is how much we pay. The other cylinder is how many people belong. If we don't have enough members and we try to cut the price to get more, all we've done is weaken the engine's output. We have to do the opposite. If we have too few members, we might have to actually charge more for the existing members until we can deliver an adequate member experience. Clubs compete on value, not price. There's some more data coming to demonstrate that. So in this period of time, March, April, May, June, we have what we've developed for free for the industry. We've doubled the participants in the last week. It's the strategic monthly dashboard, which allows every club to assess with 20 minutes of work each month. It's very simple. It's very powerful. And I know I'm sounding like a sales pitch, but since it's free, I'm not selling. We're offering a compelling service to the industry. The website is below, /monthly. It'll get you right to where you need to go. Please sign up, invest the 20 minutes a month, and you can see exactly what your trends are versus if we have it established, and you might have to help us, a local competitive peer cluster and your region and the industry at large. Because I'll tell you, after that last recession, so many clubs made so many poor decisions thinking they were unique. They weren't. The market itself turned down. If everyone's in the same boat, cutting the price isn't going to help anyone. So we need this data. It didn't exist before. It exists now. So I'm pleading with everyone. If you want data and you want to use data to make a difference, that's the way to go. It's free. In the white paper, I don't know how many folks on the webinar have read it, but there was a paragraph, and when Terry and I were editing it at the end and reading it together, this paragraph popped up. I wrote the paragraph, but this is the paragraph. If I were going to pick one out of that whole white paper that says, kind of coalesces around the thesis where the crisis is, and around the intersection of the crisis with the best practices in clubs. This is it. And I'm going to read it. It'll take the 2 minutes to read it. It is imperative clubs make decisions within the context of the strength of their membership engine. Each club must recognize that the strength or weakness of their engine in the present moment is the outcome of decisions made since the last recession. Since the last recession, we have seen clubs change the strength of their membership engine. I've been in them. I've worked with them. Some clubs that came out of the last recession with a moderate strength engine have entered this crisis with strong engines. Some clubs that came out of the last crisis with strong engines entered this one with moderate or weak engines. The market's dynamic is the point. Those shifts are directly related to decisions made in the boardroom since the last recession. They're not a result of the last recession. So the decisions we made in we make in reaction to this crisis during the coming months will have a lasting and more profound impact on our club's future than the crisis itself. That is the entire point. Let's not make bad decisions reacting to a crisis. Let's flip the whole thing on its head. And that's the whole purpose of this third time period, the second half of the year. Let's use the crisis and flip the whole thing on its head and use it as an opportunity, as Rahm Emanuel said, President Obama's chief of staff during the last recession. A crisis is too good an opportunity to waste. Let's use it as an opportunity to understand our membership engine, to understand the financial model of clubs, and to understand financial best practices, and to understand how we can address the membership experience and the value proposition so that we can strengthen the club instead of making reactive tactical decisions that will end up hurting the club. So that's the whole point of the second half of the year, is embracing the opportunity. And let's ask questions like this. This is strategic governance. Do we have a compelling member experience driving a strong membership engine? Do we understand and embrace financial best practices? Are we increasing our members' equity or net worth over time and aggregating the capital necessary to meet the future? Do we embrace data-driven leadership, or are we still steered by the loudest voice in the room, in the biggest opinion? And do we have a membership culture of owners or customers at our club? Frank Vane, I have quoted him a number of times, said on a webinar I did with him a couple of weeks ago, and I love the quote, "It's only when the tide goes out that you learn who has been swimming naked." That's a Warren Buffett quote. That's what we learn in times of recession in the club industry. The weak clubs get exposed, and the strong clubs manage better, unless they make bad decisions. We employ a variation on that observation at Club Benchmarking. Jim Butler, our CEO, says, and it's a great way to look at it, the market will always expose a weak business, a financial model. So as things begin returning to normal in the second half of the year, let's realize that the crisis was an opportunity. And then, and that's the title of the white paper, we've reacted strategically to the crisis instead of tactically. Let's use it as an opportunity to change the future by embracing the best practices, financial best practices. I'm not going to read every one of them. We're going to go through them. The first one is this. It took us 7 years of hard work, passion-driven work, flying around the country, working with boards, studying their finances, seeing the results, to realize this. And that is this. There's two ledgers in a club, the operating ledger and the capital ledger. The income statement and operating ledger are synonymous terms. Capital ledger ultimately manifests financially on the balance sheet. We'll use those as synonymous terms. 90% of the clubs in the country set the operating ledger to break even, excluding depreciation, which is considered a capital expense. The blue line on this chart proves that. So the median club had this is 2019 data again, very fresh. The median club had an operating result or margin of 1% of the revenue. At Club Benchmarking, we think that anything basically between -4 and +4%, which is 70% of the clubs in the industry, is essentially hovering around break even, right? We set the ledger to break even. We're not going to come in at some clubs come in at exactly zero, but it's, we're around break even. The point is this. If it's break even, it's not a financial driver by definition. The operating ledger isn't the financial driver in a club. It's the vehicle for delivering services and amenities to the members. The operating ledger is literally consumed year in and year out by members enjoying the club. Critical piece of learning that we have, critical discovery that we had. The gold line puts capital income into the same context as the operating result. So the club that had a 1% operating margin at the median had capital income, and I'm combining both clubs with golf and without golf here for the sake of time. The club at the median had a capital income equal to 13% of its operating revenue, which means that's the pile of money, that's the pile of cash that a club has to drive itself forward financially. That's the pile of money a club can do one of three things with. Make capital investment, one of three or all three, I should say, to be clear. Make capital investment, pay down debt, or increase reserves. So it's the capital engine and the capital ledger that's the financial driver. And I can't emphasize enough how many clubs, finance committee, boards, CFOs, controllers, GMs I've had this discussion with, when the finance committee or the board, they come in and they start cutting expenses on the operating ledger, thinking we'll have more finances for the club. We won't. All we're going to do is mitigate the dues. If we cut the expenses on the operating ledger, we're still going to set it to break even. So all we've done is cut the member experience. And remember, 93% of the expenses are fixed. They're not related to efficiency. There's not fat in the club industry. It's just, I'm not going to say there's none. I mean, I'm not trying to paint 100% brush. I'm talking about the model for 80% of the clubs, the basic model. The operating ledger is the vehicle for service and maintenance. We don't want to spend less. We want to spend more. Because if we spend more, we have a better member experience. That's point one. Point two, if we think about the capital engine, we have a metric that we have discovered that we have labeled as well that we call net available capital. Net available capital is that ultimate, it's earnings before depreciation. And we think a club should have a net, we normalize all clubs by taking net available capital and putting into the context of operating revenue. That puts all clubs, large and small, on the same metric. We think that ideally a club has a net available capital ratio of 18% or higher. That's about 30% of the clubs in the industry. 70% aren't meeting that threshold. Any club that has a ratio of 10% or under, we believe, or we characterize as capital starved. Any club with 18% or higher, we characterize as capital rich. And then the rest are in the middle in that moderate bucket. So you get the red bucket on the left, you get the yellow bucket in the middle, and you get the green bucket on the right. The key is to generate the right capital. Now, I'm going to make a point respectfully but firmly, because I'm sure we have board members on the webinar. I've run into board members who discount this theory, but they're discounting it based on opinion, not based on fact. And the theory that they have is you can generate money off of the capital, off of the operating ledger that'll impact capital. I say hogwash, and I say hogwash with confidence because of this chart right here. If you look at the sources of net available capital across in this data set for 2019, it's over 500 now. We're still aggregating data for 2019. But if you look at where the money comes from, you'd see that blue slice there that says 2%. Across the entire industry, that's the amount of capital that's been generated by the operating ledger. It's obviously paltry. We can't do it. We're not going to generate, over time, we're not going to generate capital off the operating ledger by cutting expenses. It doesn't work. If we do, and there are some clubs, I'll go back to the slide. I think you can see my cursor, but when you get up here, where clubs have operating surpluses of 10% of the revenue or so, 8-10%, they are generating a substantive amount of capital from the operating ledger. But I would contend it's a head fake, because what those clubs do is they say, we'll charge X dues to a member every month, but we're not going to allocate 50% to the operation. We're going to allocate it to the capital right off the top. Well, that's just a head fake. You might as well just call it capital dues for what it is. If it's not destined for the operation and the member experience, then that's what it is. It's capital. So let's just call it capital and separate it, because separating the capital and operating ledgers is a financial best practice. What does every organization, family, person, or business need net worth over time to do? by definition, it must increase. Based on the logic just presented from the data, if the operating ledger is a break-even outcome, excluding depreciation, the only way we can increase the net worth of a club is if the net available capital is enough to overcome the depreciation expense. If it is, the net worth will go up. If it isn't, the net worth will go down. There's 600 clubs on this chart. This is what we use as the breakpoints for the compounded annual growth rate of net worth that I showed you before. This table will help us just look at the industry. That upper quartile of net worth growth, those clubs at 5% and over, those clubs are able to generate enough capital. I'm going to define this in a minute, to meet obligatory and aspirational capital needs, meaning they can not only repair and replace the assets they own properly, they can actually add to and expand the asset base. That's what aspirational capital is. The clubs that are in that third quartile, between the median and the 75th, tend to have enough money to keep up with obligatory capital, but not with aspirational, without using debt or assessments. The 25th percentile to the median, they're shrinking. They just don't have enough capital even for obligatory. It's what we would call a slow motion crisis. The clubs in the lower quartile are shrinking in a mission critical manner. The situation's critical, and if it's not arrested soon, eventually these clubs are going out of business. The one thing that's interesting about the club industry is we literally, as club owners, control our own destiny. In pretty much any business, you can't grow equity in the business without consideration of competitors and the market dynamics. In the club industry, any club can grow its equity by doing one thing: charging the members who are there enough in capital to make sure it grows. And then you can grow your business doing that. The capital provides the money to grow the business. So growing out of a problem in the club industry, now I'll use the word turnaround. It's a heck of a lot easier to do a turnaround in the club industry than most industries. That's the reality. Equity on any balance sheet is important. It gives you an insight into the financial outcome of the business over time and how well it fares in its marketplace. The best example I found when I was writing the white paper was in the lower left here. I heard on the news, since the crisis started, Amazon's hired 100,000 people because their business is exploding, because it's easy to order online than to go out into society. I looked at Amazon's compounded annual growth rate of equity since 2006 to put it in the same framework as what we're doing with clubs. It's 47%. Why the heck didn't I buy that stock? Then I went and looked at Macy's. Macy's has furloughed the entire staff during the crisis. Their compounded annual growth rate since 2006 of equity is -6%. I hope no one from Macy's is on the call. I have great empathy, but we know where that business is going to end up eventually. The movie is in progress, and it's not a hard ending to predict. The point is, Amazon is relevant in 2020. Macy's is a lot less relevant. And ultimately, the compounded annual growth rate of equity in clubs reflects the same thing. Is the club relevant in today's day and age, or is it not? This balance sheet model that we have here, that top line in green, the strong club, is a real club. The club in red is a real club. And the club in yellow represents the average club in the industry. The weak club, look to the right side, the average club has 70% of the money it's garnered over time emanating from members' equity and 30% from liabilities. In a club, liabilities is mainly bank debt. The average club has a debt-to-equity ratio of 20%. The strong club, 90% of its equity, 90% of its money has been garnered from members' equity, which we have already learned. And let me step back. When you think about members' equity now, over time, what members' equity in a club is it's this. It's the sum total of all the capital contributed by the members minus the sum total of all the asset depreciation over time. That's what you're left with is members' equity. The strong club is 90% equity, 10% liabilities, and the average club is 70-30. The weak club has a debt-to-equity ratio of 450%. So that club, over time, has found it easier to go to a bank and ask for money than it has to go to its members and ask for money. But that's just a shell game. Because how does debt get paid back in the future in a club? Well, it gets paid back by members contributing capital to pay the principal back. So all debt is a shift of the burden of capital from historical members to future members. It's a very poor practice to use debt to fund obligatory capital investment, as is evidenced here. If you look at the other side of the balance sheet, assets, the thing that all three clubs have in common is that 80%, give or take, of the assets end up on one line item, and that line item is the net book value of property, plant, and equipment. Ultimately, members' capital in clubs is destined to be invested in property, plant, and equipment. We discovered another ratio in the epiphany we had regarding the balance sheet and capital 4 years ago. That ratio is that we term the net to gross property, plant, and equipment ratio. It's simply a measure of how depreciated the assets of a club are. The ratio will be between 0 and 100% for every single club. There's over 600 clubs again on this chart. The median in yellow there, the average club, has a net to gross property, plant, and equipment ratio of 46%, which means that club has an asset base that's essentially halfway through its depreciated life. The strong club, which was founded in 1922 and 9, has a net to gross property, plant, and equipment ratio of 65%. That means that the assets are fresh. They're up to date. They don't look worn and tattered. Look at the weak club. It has a net to gross PP&E ratio of 38%. At club benchmarking, we think that the target is 55 or higher. It also happens to be the 75th percentile, which means 3/4 of the clubs in the industry have deferred maintenance of their assets. Look at the initiation fee in the 4 quartiles. The clubs with a high net to gross PP&E ratio, the median initiation fee is $40,000. That third quartile, 30, the second quartile, 25, and the first quartile, 10. It just reflects who's going to pay a higher initiation fee. A prospective member walking into a club going, wow, this place is nice. This place is maintained. Or a prospective member walking into driving into a club first with potholes in the parking lot, then walking up a stairway where the bricks are out of place, and then walking into a clubhouse where there's holes in the carpet, or it smells musty and moldy, or the furniture and tables look like they were put in 1995. Obviously, the one with the fresh and up-to-date asset space is going to be able to garner a higher initiation fee, and vice versa. So I think I'm going to take another breath, see if we have some questions, because I think we can all see right now how these things all tie together logically. The data ties very tightly, and they all just represent ultimately, the strong membership engine, the weak and moderate membership engine, and it all hinges on a member experience and our asset base. Terry, are there any questions?
I'll give you 3. Okay, first one, dollar for a club with golf, where on property are dollars best spent investing in member experience and value and the return on investment and member retention or attraction? If it's the golf course, what are the next areas?
Okay, so if it's a club with golf only versus with golf, there's a big difference. What happens is, and just refresh my memory again, please, Terry, can you see the cursor here on the webinar?
Yes.
Yeah.
Yes.
So the clubs that are in this bucket over here with golf, that have the depleted asset base and the low initiation fees, those clubs tend to be golf-centric or golf only. They have a harder time attracting members in 2020. These clubs have golf also, like the strong club, which I'm very familiar with. But they also have resort-style pool, updated casual dining. indoor tennis, fitness, wellness, physical therapy. I'm not exaggerating. They have all the spa services, salon services. So they have a much broader appeal to a lot more people than the golf-only, a golf-centric club. So if you're in a golf-centric club and you ask me that question, my first answer, and by the way, this club that's the weak balance sheet, and they have a weak membership engine, if we went back 20 years and we made a list of the 50, it's a country club, but it's got a bathtub-sized pool that hasn't been touched in 50 years, and it doesn't have fitness. It's got a fitness closet, not a fitness center. But the debt that was taken on by this club that gave them this debt-to-equity ratio 5 years ago was invested in the golf course. Unfortunately, that's not enough to drive prospective members into the club. 20 years ago, when things were more centered on golf, this club would have been a top 50 club in the legacy clubs in the largest cities across America in this case. So the point is, if you're in a golf-centric or golf-only club and you're trying to get out of a lower end of the spectrum, you got to get your way out of there probably with something other than golf is the reality. If you're in a country club with golf and you're trying to move to the right, it's the same story. You probably want to begin investing not in the golf course unless the golf course is completely upside down. And that would take a specific discussion, but you probably want to start investing in other areas first. Any others?
Lots, yes. It sounds like a club should be budgeting 15 to 20% above their annual cash flow budget to fund for future capital improvements and reserves.
I'm not sure where the 15 to 20% came from, but we'll say this. If you look at net worth over time, we think in order, and we can get into, and we're happy to get into side discussions after the webinar. If you think in terms, well, let me get through this one slide because it'll help answer this question. Here's the two types of capital: obligatory, aspirational. Obligatory is repair and replacement of existing assets. We believe the financial best practice is to support that with recurring capital dues, not assessments that come and go. We are not fans of assessments at club benchmarking. The members who consume the capital should pay for the consumption as they consume it, which is recurring capital dues. The club with the strong balance sheet here, the reason they look this way is they started to fund depreciation with recurring capital dues in 1954. So since then, they have been able to use all their initiation fee income for aspirational capital, which we think is the best practice, and they've expanded and added to the asset base consistently over time. Remember the club with the picture of the 3 resort-style pools? It's that club. So they had a practice just like this since 54. What we're doing now is we're working with clubs to put in place a precise and comprehensive forward-looking capital plan, which we know now from this data and research is the cornerstone of a sustainable financial outcome, so that clubs can meet their obligatory needs and can meet their desired aspirational needs, but not reactively using assessments, proactively by garnering the capital year in and year out to do so. And the way it relates is this, back to the question. We think to just meet obligatory capital, but meet it in a wholesome manner, that a club needs to increase its net worth at least 3.5% a year. So that's the metric that questioner should use. Now, if the club has deferred maintenance like this club, there's more money on top of that 3.5. But the key to success is we got to do the capital planning to get the net worth engine going up, because that's indicative of enough capital income to start reinvesting in the property, plant, and equipment. And the forward-looking capital plan is detailed here. You need a capital reserve study. It's got to be done, in our opinion, objectively by a third party. We run into clubs, and I've heard this before. Oh, we got a guy who owns an HVAC business. He'll do a capital reserve study. Well, he knows about HVAC, and he can go up on the roof and look at that. But who's going to do all the furniture and fixtures and carpeting? Who's going to do all of the kitchen equipment? Who's going to do the sprinkler system, the greens, the cart path, the pool, the tennis courts? We need people that are cognizant and versed in capital reserve studies to do a capital reserve study. Every club needs one. Our estimate is less than 15% of the clubs in the country have one. Then we need a strategic plan in strategic thinking and vision to form the basis of what our forward-looking aspirational needs are. Then we take that together with our planned member churn, every category. How many members do we expect to come in and out year by year? We think this forward-looking capital plan should be a rolling 10-year horizon. Every year we add a new year on the other end, on the end of the 10. And that forward-looking capital plan is the basis for keeping clubs strong or making clubs that are weak or moderate strong. It's that simple. Any more questions? And then I think I'm on the last couple of points here, and we'll
I
finish
think
up just about on time.
We're 2 minutes out, so I think let's let Ray finish. Keep putting your questions in the chat pane because those are all captured there, and then we'll respond to you by phone or email afterwards, and we may also distribute a list of the questions and the answers to them.
Okay, perfect. So I'm going to just make one more point. This is the final best practice. Financial best practice is a recognition or an understanding that clubs compete. I've said this in the webinar a couple of times. This is the demonstration of that with data. Clubs compete on value, not price. So what you see here is the initiation fee first, and with some other data than we saw before. The member count increases and the dues increase. So the clubs on the right side of the spectrum are the ones with the most members. They're also the ones with the highest initiation fees and dues. And the clubs with the lowest members on the left side are the clubs with the lowest initiation fees and dues. So the point is, clubs with higher fees have more members and more success. That's, by definition, competing on value, not price. The next way of looking at it is this. I've been in so many clubs, so many discussions where I've seen how, I want to phrase this diplomatically, how much harm can be done by folks who have good intentions but don't have any data, and they come out of an industry that might compete on price, and they think that that means that every industry competes on price, which is not correct. And every time they see a nail, the hammer is cut cost. Well, there's a thesis behind that. If lower costs are better, then the clubs that have the lowest cost should be the healthiest financially, and the clubs that have the highest costs should be the weakest financially. So what this shows, and I put both golf and non-golf in one bucket for the sake of time, it just shows the total operating expenses of all the clubs, the over 500 clubs that we've gathered the data for from 2019 again. I keep pounding that point home. It's fresh, up-to-date data. The clubs in the upper quartile have operating expenses that are $10.5 million or above. The clubs in the lower quartile have operating expenses that are $4.7 million or less. Well, look at the full member equivalents and look at the initiation fee in the lower quartile, and look at the initiation fee in the full member equivalents in the upper quartile. We don't want to decrease the expenses in a club. We want to increase them. If we increase them, we're more able to deliver a better member experience. This is the demonstration of it right here in living color. We don't want to go to the left. We want to go to the right. If we're leaning on decisions in the boardroom, now remember the context for this, please, is we're in the second half of the year. We're still all feeling the queasiness over the virus, and what happened in the industry. And we might be a little tentative, and we have to decide, are we going to cut costs or are we going to invest in the experience? Our advice to the industry and any club we work with is, on the margin, and I really believe in business and in sports, victory and defeat is on the margin. Everyone's competitive. It's the key decisions made at the key point, at the key time on the game that drive the outcome of the game. If we're on the margin, I'm not saying to any club, double your dues overnight. But if a club's trying to decide, like let's take the full member dues in that lower quartile, 4,485. It's after the crisis. It's in the second half of the year. Maybe the membership engine stalled. Maybe there's a little more attrition than there is intake, and they're trying to decide: should we lower the initiation fee from 5 to 4, and should we lower the dues by cutting expenses from 4,500 to $4,000 to get more members, or should we make the dues go from 4,500 to 5? So we have more money to invest in the member experience. Maybe we don't increase the initiation fee from 5 to 6 yet, but we certainly don't cut it to 4. Always, the data shows very clearly, always, the right answer in the club industry is to lean forward. On the margin, ask the members for a little bit more money so we can invest more ably in the member experience. That's the whole point. I've been in clubs. I'm not making this up. I did a board retreat at a club, a yacht club, I don't know, a few months ago, where I'm going to guess the average net worth of the average member is north of $1 million, probably closer to 2. And the culture of the club over time has become like, we don't want to invest and don't charge us more for dues. And I think it was this. You can't make this stuff up. I couldn't make it up if I tried. I think the proposal was $8 a month increase in dues. People were apoplectic. Seriously? Seriously? Everyone on the call, in this call, whether you're a staff member at a club or you're involved in the governance of a club, everyone on this call has seen this happen in their club. Clubs say, we're going to raise dues $20 a month. 20% of the membership goes berserk. And then after going berserk in the annual meeting, they go to Morton Steakhouse and drop $500 on dinner. The whole dues thing in the club industry is emotional. It's emotion. And I suggest, I can't prove this, but my view, and the reason we did the study on efficiency is, I think that there's certain folks that think if you're asking me for more money, it's because you're wasting the money I'm giving you, as opposed to what we've demonstrated with data today, to thinking that, no, we have a footprint we have to fund, and we haven't been funding it properly, and we just got to start funding it properly, or we're going to drive ourselves into demise. The whole thing about dues is an emotional thing in clubs. I remember one board retreat I did. The club has an initiation fee of $100,000. They wanted to raise dues $40 a month. People were apoplectic because they have a culture of low dues. Past presidents walk around the club and say, we didn't raise dues under my watch. What the hell's wrong with these presidents that are trying to raise dues? Well, I went around the table of the board and asked everyone, where'd you go on vacation last year? And there wasn't a vacation around that board table that was less than $10,000 for a week. Some of them were 20 or more. It's an emotional issue. And on the margin, and this is the advice for the second half of the year, on the margin, lean towards value, not costs and price. And in summary, I hope we've demonstrated it clearly. When you look at the operating ledger and the operating money, that's all about the member experience. If we don't have enough operating money, the member experience declines. When we look at the capital ledger and the capital money, if we don't have enough money, the net worth will first decline, but that'll be followed by a stagnating footprint and assets that become depleted and irrelevant over time. And this is all about this. Looking forward, as opposed to worried about what happened against budget last month on the income statement. Our view is 90% of the boards in this country are operationally oriented. I should say North America, because we have our Canadian friends here too. And I love our Canadian friends, and I love our Canadian clubs. I really do. I'm an old hockey player. 90% of our boards in North America are leaned towards operational governance. We're trying to use this data. We're trying to use this crisis. We're trying to use this framework to get them to start leaning towards strategic governance, which is looking forward not backward, which is looking to capital, not operating, which is looking to the value proposition and the member experience, and understanding that's ultimately what drives growth. And if we ain't growing, we ain't relevant, and we got one metric, and we do it for free. Another free service we do for the industry is the net worth and balance sheet benchmark. If you don't have one from us, send us an email. We'll get it right back to you. We turn them around instantly, practically, and you'll have a whole different view of what's going on at your club. We have to consistently invest in the club over time. If we're going in the wrong direction, we have to ask the current member owners to start investing more to get the engine going in the right direction. So in summary, please, in the first period through the end of the shutdown, don't make decisions that have long-term consequences with short-term information while we're under stress. Do not cut the initiation fee. Do not hack away at the operating and capital budgets for the year. It's a tactical issue. It's a tactical time period. Just focus on the short-term shutdown. May through June, it's all about tracking the membership engine and understanding it, understanding where we were when we entered the crisis, understanding the market. Please participate in the strategic monthly dashboard. There is no other way I know of to systematically and accurately understand the market and what's going on in the market and how our club is faring relative to the market. And then through the year end, once we get through the acute crisis, it may not be completely wiped away, but let's start embracing best financial practices. Let's start embracing strategic governance. Let's start creating the future with our forward-looking capital plan, a real one, not one that we wing it. I've looked at so many. I asked clubs, "Can you show me a forward? Oh, we got a forward-looking capital plan." I say, "Oh," and I'm doing this quick now because this is all out of empathy, as I think anyone that knows me knows that with my service at my own club. If I look at capital plans, and I've looked at hundreds, they're not complete. We need to do this very thorough. It's got to be top to bottom. It's got to be done professionally. Frankly, I think it's got to be done, and it can't be done properly without outside help, in my view. Obviously, I'm biased in that regard. And then finally, do not, please, there's two ways of looking at this crisis. There's two ways clubs are going to react, just like they did to the meltdown in 07 and 08 and the 09 recession. We're either going to use the crisis as an opportunity to change our future, meaning we've reacted strategically, or we're going to be tactical and we're going to start cutting away and hacking away at costs and expenses, thinking that's the answer. Please, please, please don't do that. And I went over by 10 minutes, I'm sorry. But happy to take any questions that may still be on the table, Terry.
Do we want to do them, or do we want to leave it open so that they can type them in? Do you want to take some more live?
Take a couple more live, and then what we're going to do, everyone, is we collected the questions that were remaining from Tuesday's webinar. We'll also collect the questions that are remaining from today's webinar. And Terry's done a great job of organizing those. We're going to send to all the attendees of both webinars our specific answers to all the questions in a spreadsheet. And so everyone will have access. That'll be actually kind of a really valuable knowledge base, but everyone will get that. It'll probably be early next week when you receive that. But in the meantime, let's take a couple more, please, and then we'll let everyone go enjoy half a Friday.
Okay. I believe the clubs that will, whoops, they're jumping on me. I believe the clubs that will come out of COVID-19 with the strongest, they're throwing questions in as fast as I can read. I believe the clubs that will come out of COVID-19 with the strongest membership levels will be positioned well moving forward. What are ways that clubs can mitigate member loss other than just saying it's their responsibility? Specifically, the social members, for most clubs being at highest risk because they have the least investment and have no access during the closures. However, they account for 25 to 30% of dues.
It's a great, really good question. One thing I didn't mention when Frank Vane and I did the webinar yesterday with NCA, we started talking about innovation. I did mention it briefly earlier. We've seen some real innovative ideas of engaging members during the shutdown. One of the issues in the club industry that we have to also address is frankly the lack of innovation. there are so many potential ideas. Like take that question, that club specifically, and I'd love to talk with whether it's a manager or a board member at some point. It would be great. There's lots of ideas we could come up with if we think freely and openly, which sometimes doesn't happen easily in the club board or committee meeting room. But if we do think freely and openly, and we did some real brainstorming, I'm guessing that club could come up with 10 or 20 ideas to re-engage with those social members in a very intimate way after we get through the shutdown, so that those social members actually become more engaged rather than less engaged. And by the way, we might not even have to wait until the shutdown's over. We can begin it now. There are tons of creative engagement ideas that are out there right now. I know one club right here in Boston where the senior staff took the membership, the whole membership, and it's a pretty big club. I think there's about 2,000 members. It's a city club. And they started with the members who were aged 80 and over, and they split those members up amongst the senior staff. They each were assigned, 30 or 40, and they called each of the members. This is going back like to the beginning of the crisis. And they said, is there anything we can do for you? Do you need some help? Are you with someone? Would you need anything at the grocery store, anything at the pharmacy, anything we can bring you from the club? What can we do to help you if we can? If you don't need it, that's fine, but we want to make sure you know we're here if you need anything. And then when they got through the 80 to 90-year-olds, they did the 70-year-olds to 80. Then they did the 60 to 70. Then they started with the rest, and then they went back to the top and did it all over again. It's just one example. There's many, many more. But the key, I think the answer to the question is, let's think out of the box. Let's do some real brainstorming. This is the thing about board meetings, the monthly board meetings, when we spend a half hour worried about cost of goods sold and food and beverage last month against budget, but we never have time to think strategically. This is the deal. Let's start thinking innovation. Let's start thinking creatively. Let's think out of the box. Let's think about member engagement, and don't restrict the ideas. Try stuff.
Okay. How much of our financial position should we share with our members without causing panic?
That's a very good question. And I would say, I don't know if that's a client of ours or not, but if it's a situation like that, I would say, obviously I'm biased right now, but first, you make sure you understand your financial situation as well as you can, and that means you need context, which we provide with these charts. You need to understand where you are in relation to norms. We need to know where exactly we're weak. But in the end, once we know where we're at, we have to share everything with the membership, because the only way we're going to change it is with their engagement and affirmation. So we have to use data to get everyone aligned. In the way that whole thing starts is creating that forward-looking capital plan that I referred to. And it's all about 100% transparency in my book. But not in a winging it. I'm using that. I can't come up with the right word there. We can't wing it. We got to be really comprehensive, really precise, and really clear.
Okay.
Hello?
I'm here. Sorry. And I think we're 15 past now.
Okay.
So I think we'll let folks go. We're going to leave the screen open. So if you want to type a question in, you can. Ray will freeze his screen. You can type your questions in. I'm just going to stop recording, and we'll give it another 5 minutes till everybody's had a chance to sign out. And thank you so much for joining us.
And once again, sorry for Tuesday. Hopefully this made up for it, and everyone have a great weekend. Happy Easter, happy Passover, and virus-free to everyone. Thank you very much. Thank you, Terry.